We are currently witnessing a massive stock market melt-up. A historic 10-day rally just pushed major indices back toward all-time highs, shattering previous records. This momentum isn't limited to stocks. Institutional money is flowing back into Bitcoin at a rate that drove double-digit gains in a single month. But behind these soaring valuations, something is breaking. While investors celebrate new highs, the people fueling the economy are reporting a very different reality. Consumer sentiment has collapsed. Everyday people are expressing a level of economic anxiety that hasn't been this severe in the 70-year history of the survey. It is an era of maximum contradiction, a booming investment landscape running parallel to a record-breaking low in household confidence. Navigating this cycle requires identifying the specific mechanics driving the split between the numbers on Wall Street and the reality on Main Street. Main Street's outlook is currently dominated by a single variable, the price of crude oil. Because it powers the ships, trucks, and tractors of the global supply chain, it essentially controls the price tag of everything we touch. The math is direct. Data shows that every $10 increase in the price of a barrel of oil raises broad inflation by 0.2%, while simultaneously dragging down overall economic growth. When oil recently surged past $100 a barrel, it pushed inflation to 3.3%. For most households, that translates to an immediate, non-negotiable squeeze at the gas pump and the grocery store. These stubborn inflation readings have completely changed the outlook for the Federal Reserve. Any plans to cut interest rates this year have been frozen. High interest rates mean high mortgage rates. This has effectively paralyzed the housing market, with national home appreciation expected to remain flat as borrowing costs keep buyers on the sidelines. For the average family, it's a linear chain reaction, where one commodity's price hike makes daily survival significantly more expensive. Wall Street ignores this immediate pain because the stock market is a forward pricing machine. Valuations aren't based on how you feel today. They are based on what investors expect next year. This timeline illustrates the disconnect. While Main Street is focused on today's expenses, institutional algorithms are exclusively measuring projected corporate earnings and growth 12 months into the future. There is a historical irony at play here. Markets often find their strongest momentum during periods of maximum consumer pessimism. One major future variable Wall Street is currently pricing in is the end of Jerome Powell's term at the Federal Reserve. His expected successor, Kevin Warsh, has indicated he wants to shrink the Fed's balance sheet, a move that would mean less money printing and tighter liquidity. Political pressure adds another layer of uncertainty. Donald Trump has been vocal about wanting lower interest rates, raising questions about whether the next Fed chair will be able to maintain strict independence. Because the market is constantly digesting these future shifts, trying to predict price movements based on today's bad news rarely works. Individual investors are at a massive disadvantage when trying to outpace hedge funds and institutional systems that process these forward-looking variables in milliseconds. Waiting for the economy to feel safe or clear is often a costly mistake. Those who sat out during recent periods of high anxiety missed one of the most aggressive rallies in market history. We saw this recently with Bitcoin. Investors who hesitated during the drop to $60,000 missed a nearly 30% upside move that happened while sentiment was still overwhelmingly negative. A common strategy for navigating volatility is dollar-cost averaging, investing a set amount at regular intervals. This accepts that portfolio drawdowns of 30 to 50% are normal, prioritizing time in the market over timing the market. This requires a level of discipline that ignores inflation spikes, Federal Reserve leadership changes, or plummeting consumer confidence scores. Generational wealth accumulates through the simple act of expanding your timeline and staying consistent through the noise of every cycle.